We think a surge in gold could easily carry to the mid 2000s, maybe 2700 even, just rapidly, a gusher. Actually, percent wise, that's not a big deal if you think about it. And if you go back and look at the history of gold over the last 50 years, there have been a couple bull markets that were eightfold moves. Okay. The routine, eightfold. Well, our low was 1,050. What's eightfold? Okay. $8,000. Okay. Ultimately, it wouldn't shock us that we do another, quote, routine move in gold. But the fundamentals out there, the economic, political background is, we think, historic. And we think the wave effects for gold and silver could be far more dramatic and also more chaos theory.
In a recent interview with Liberty and Finance, Michael Oliver, founder of Momentum Structural Analysis, shared his outlook on major shift underway in the asset allocation of major investors. Oliver is a strong advocate for investing in precious metals, and he believes that they are a hedge against inflation, geopolitical uncertainty, and financial crisis. Oliver believes that investors are increasingly moving away from traditional assets, such as stocks and bonds, and into precious metals, such as gold and silver. According to Michael Oliver, gold has recently displayed a triple top pattern on its price chart. A triple top pattern is often perceived as a bearish signal and is formed when the price of an asset reaches a certain level on three separate occasions and fails to break through it. Oliver highlights that while gold reached high price levels, silver failed to keep pace and did not exhibit the same level of bullishness. As the price of silver encountered the resistance, it experienced a retracement and pulled back to the low to mid $24 range. Oliver warned that investors and traders should closely monitor the price action for silver and gold. These levels could be important in determining the future direction of the precious metals market. Let's watch Michael Oliver's interview snippet with Liberty and Finance. Make sure to watch the full video, and don't forget to subscribe and click the bell icon so you don't miss any of our latest content.
Gold has set a triple top on a price chart. If you keep pointing figures, X and O charts, $50 by 3 block reversal, you've got three highs at 2050, 2050, and 2050. That's 2020 high, 2022 high, and a recent high. None of them touch 2100. Okay, so you're sitting there on this point and figure chart at a triple top. After having blown out a triple bottom in last summer and fall, falsely, we said it would be a false price chart breakout. Sure enough, it was. You had repeated lows at 1700. We went down to 1650. Now, when you have that kind of box on a point and figure chart, if you're just a point and figure guy and that's your universe, if you have a box like that and you blow out one end of it and it's a trap and you go back to the other end, it won't be a trap. It'll be a valid breakout. So when you hit 2100, there's a whole bunch of people going to say, oh, golly, I missed it. I better get in this. Okay. Our number on silver, its old high in 2020 was $30. It made a high in that March 22 rally when gold was back up to its high. Silver wasn't. Silver was up in the highest weekly close was like 2610. Again, this is March of last year. We came back up again above 26 recently and pushed and pushed and pushed. They couldn't get through there. And then they backed off into the low 23s. Right now we're in the low to mid 24s. We argue if you get back over 26 again, watch out. They're going to blow your head off. And the same with gold touching 2100. So those are numbers we'd watch if we wanted to have a larger position or if we're not positioned in those markets. You see 2100 gold, it's a breakout. It's valid. You see 26 plus silver, watch out. That's the point at which when you go through those numbers, we think those two metals will then move from an arm wrestling upside move to something more explosive. What has been going on since basically March in gold and silver has been repeated selling in those markets that has really not produced much downside. In other words, if you've been short gold, let's say not at the exact top tick of the rally, but let's say around 2000, well, you're making 20, $30, and it's been several months of selling. So even from just a price chart point of view, if you're a bear, consider that. Okay, if you're a bull, consider how the bear feels. He doesn't feel real great. He's not really making a lot of money. And in one good day, we could blow him out. Okay.
Regarding the impact of the Fed potential pause or lowering of interest rates, Oliver emphasizes that it could have short-term positive implications for the stock market. However, in the long term, it will be a negative for the stock market and gold. These temporary declines serve as natural corrective phases within broader trends. During the interview, Oliver also pointed out that the recent pullbacks in silver and gold have been driven by a number of factors, including rising interest rates and a stronger U.S. dollar. He believes that the recent pullbacks are a buying opportunity and that the potential shift in sentiment regarding the stock market could lead to more investors looking to gold as a safe haven asset. Let's listen to the Oliver's interview.
I think that the pullback we've had in silver probably saw us low in the low 23s 2 weeks ago, 2 to 3 weeks ago, retested repeatedly. Right now we're trading in the 24s. I think that probably was the corrective low. For gold, we've got some numbers basically a few dollars above today's close. Official settlements around 1955 on the June contract. You close a week out above 1956 by much, and our weekly momentum, which is a fairly short-term metric, says, okay, you're out of your corrective mode, you're back into the upside. So we think we're at hand on doing that. Stock market's a different issue. While gold has been pulling back over the last several months, not much, but the stock market has been pressing upward. Again, not much, especially if you look at the S&P. While gold was in a range from 2020 summer high, 2022 high, and recent highs, sort of a flat range, silver was in a slightly downtrending channel. I'm talking price now. Silver burst through that channel earlier this year, especially by March, was very evident. The pullback is basically dancing on top of that channel. So even from a price chart perspective, this pullback is a pullback in now what is an emergent uptrend. Okay. And we're just spinning our wheels up here. I know everybody's anticipating that if the Fed pauses, oh boy, stock market's going to party. Don't bet on it. If you take a Fed funds chart and go back through history and look at what happened up to 2000, the year 2000, the dot-com high, the Fed had been raising rates. In early 2001, they started to cut rates. Did that save the market from a bear market to the 2002 low? No. They cut rates all the way down. The market went down anyway. 2007, they've been raising rates all the way up to the 2006, 2007 period, and rates peaked, I think it was at 5.25% Fed funds in the summer of 2007. They actually started cutting rates while the market was still at its highs. That's above 1,500 S&P. And all the way down to the bear market low of 2009, the Fed cut rates, but it didn't save the market. So those who are hopeful that if the Fed pauses or maybe ultimately starts lowering rates, that'll help the stock market, don't bet on it. History's not on your side. And I think that's probably important for gold. Silver is much higher than it was in 2021. Gold is a couple $100 higher than it was in 2021. Okay, so those asset categories will attract further money flow out of those evacuating the stock market. So to some extent, if you're in gold, start to watch the stock market again, because if we see a sign of rollover, it's beneficial to gold.
Gold prices fell to a 3-month low on Thursday, as hints of further interest rate hikes by the U.S. Federal Reserve bolstered the dollar. Spot gold fell 0.3% to $1,820.54 per ounce by 03:30 GMT after hitting its lowest since February 11th earlier in the session. U.S. gold futures dipped 0.2% to $1,826.50. The Federal Reserve is expected to raise interest rates several times this year in an effort to combat inflation. Higher interest rates tend to make gold less attractive to investors as they offer a higher yield. While gold reached high price levels in recent months, silver failed to keep pace and did not exhibit the same level of bullishness. This is likely due to the fact that silver is more industrially used than gold, and its price is more sensitive to economic conditions. What do you think the price of gold will continue to fall, or do you think it will rally in the near future? Make sure to like, share, and subscribe to our channel for more updates.